So OPEC is cutting production. Tesla came out with some delivery numbers, and is Apple coming out with a new headset? We're going to talk about these things, go through some headlines. I'll share my thoughts and get yours as well as we go through the daily news. So this is headlines right now. It's kind of the big one. OPEC makes surprise 1 million barrel cut and new inflation risk. And essentially, and they keep referring to it as the cartel. The cartel is basically like, you know what? We need to get prices to go up because we make oil. And essentially, if everyone cuts at the same time, you know, limiting supply. And in fact, prices probably likely will go up. So Saudi Arabia is cutting 500,000 barrels. You got Russia cutting 500,000. And then you got Iraq in there, UAE, Kuwait, Kazakhstan, Algeria, and Oman. But essentially, these are the two big ones. And, you know, other countries do follow, and that's essentially how that works, right? It's a cartel. Japan, I guess, evidently is buying Russian oil, which is essentially kind of breaking with allies, and I guess they're also buying natural gas. So that's not helpful to the war effort in Ukraine, and also part of this as well, basically Japan is just saying, hey, you know, we don't have enough on our own, and, you know, we need oil, help us out here. There's not enough oil necessarily to go around, I guess, and one thing I would say is, you know, hopefully we'll get off this stuff eventually and go to something alternative. Regarding tech as well, this was an interesting article where we talked about this several times on the channel. Sometimes there's a diagram that comes out that sort of illustrates things further, which I think is good to talk about. So basically, headline, right? How big tech camouflage Wall Street crisis. But one of the things that is important to understand is when people say, hey, buy index, understand that it's heavily tech weighted. Essentially, the tech companies just are really, really big, and they make a big part of the S&P. So in this example, they were just focusing on Apple and Microsoft. But right now in the S&P 500, like Apple 7.1%, Microsoft is 6.2%. That's like what 13% of tech is like those two companies. And in particular, if you look at all of tech in the S&P, you know, in 2021 it was about what 29%, and it still hovers around those ranges, right? Like kind of a third of the S&P is tech. It's really, really overweighted, and so this is a problem, and sort of it's not necessarily like a fault of like how the S&P 500 is constructed. It's just that the tech companies have done really well, and so certainly in a zero interest rate environment and when things are going great, you know, everyone's making money, and it's kind of funny because interest rates are going up now, and so you have a lot of people like, okay, crap, what do we do? Because tech has been the one that's been working, you know, all this time. Do we start investing in other types of things? And this is when I think what scared everyone was when the banks started failing. You're like, okay, crap, interest rates are going up. Tech, you know, is that where we go back to because banks are untrustworthy? And I've been noticing in TV and media that like, oh, you got to go to tech because everyone goes to tech because it worked the last 10 years. But I'm not so certain on that because, again, interest rates are rising. And I always have the main question is like, you know, now that you have an iPhone, for example, do you need to buy one every single year? Is that something that Apple can convince you to do? And we're going to get into more of this thing, but I wanted to mention this though, that it is a problem to where the S&P isn't necessarily equally balanced to equal exposure, right? I just think everyone has too much exposure to tech. Although to be fair, right? You know, if you're ARK Invest fan and that kind of stuff, yes, tech goes innovation, I get it. But in a rising interest rate environment, right, things change. This is an interesting one. So the Buffett indicator, they changed the way that they show the chart. So it's a little bit more trickier to read. And if you follow the channel, we look at this from time to time. This would suggest that we're just under a standard deviation above the mean. So you could say that we're around fair value. I say around, but we're still above it, right? So that's your sort of your historic, and we're definitely not undervalued. And this is essentially what it does. It compares the value of the market compared to the GDP. Now, you know, if GDP growth, you know, increases, like, for example, we have massive GDP growth, then that would, you know, say, hey, maybe stocks are undervalued. But if you expect GDP to go down and you expect, say, earnings of companies to go down, then, you know, then we'll be overvalued. But that's why you got to look at more than one thing. So, like, for example, in this example, this would be your 10-year PE. This would, you know, price of stocks compared to how much company earn. This would also put us around a standard deviation above the historical mean, right? Do you guys see what I'm saying here? So both of these would say we're a little bit overvalued. That's sort of what my estimate would be as well. One thing that I mentioned before, though, is when you go into earnings, the question would be, and this is a question that all the companies are going to be trying to answer to investors, is did we cut costs enough to make, you know, earnings attractive? So for example, UBS, they're saying they're going to be, cutting 30% of their staff, right? You got to cut costs to get those earnings up. But obviously, it's not so great if, you're one of those said staff. That's why I've been warning you guys about these things. Or something like, your Google, they're going to be cutting a lot of benefits to companies. Again, it's all about keeping those earnings up to keep Wall Street happy. So you're cutting like your free food, you're cutting your fitness classes, you're cutting your shuttles to work. So the companies, that's what they're doing. They're cutting costs, and then they're going to try to convince you that the forecast is going to be great and they're going to make more money in the future. And we'll see what it holds in earnings reports, right? So this is essentially a forecast game of how companies are going to do. And one of the things I always try to emphasize with you guys as well, you want to be thinking about, okay, what are alternatives where you could, be putting your money? Do you want to be looking at, treasuries, these kind of things, money market accounts stuff? So right now, the 2 years at 4%, the 12-month is at 4.59, and then the 10-year has actually dropped a bit, 3.47. So you still have the inverted yield, so that would signal a recession. It's the one that we all keep talking about, but it's like, is it coming or not? My bet is still on probably, but I think, because I can't pick the future 100%. But I do think, and I mentioned it several times, is that if you say you're part of the group at UBS that's getting cut like 30%, then yes, that's a recession for you. And that's why I always talk about jobs and try to give you guys a holistic approach. Individual investors, they're starting to slow their purchases. And why we're talking about just not Tesla specifically, but just individual investors, is that we've seen this a couple times before, to where Tesla is honestly the most popular stock among people out there, retail, who are buying individual stocks. It's been the most popular one. And the money has been flowing in. So you can take a look at here. This is a 10-day rolling. That's how they do this. But here, it peaked, right? So there's a ton of money coming in, and that's definitely starting to come down. So the purchasing of like stocks like a Tesla or whatever has definitely been slowing. You can see the numbers here. This is money that is going into money market funds. So it looks like, some people are essentially slowing their purchases of stocks and just saying, you know what, I'm playing it safe, going to the money market. We've talked about this. A lot of big money is doing that as well. You can also look at this. This is basically the same thing as the other chart. This is the purchases of Tesla stock, right? So it's certainly has a run up. Many people were buying the Tesla dip, and the purchases of Tesla certainly slowed. Either, interest has waned, or people have run out of money, one of the two. You guys can make the decision for yourself, but you can see it in the numbers. Now they came out with their deliveries. It's funny because it depends which headlines you want to read. So in this particular one, Tesla deliveries rise to record after slashing EV prices. They did miss the estimate. I think they missed it by like 4% was what it was, but they are still selling cars. It's a true story. Tesla does sell cars. You can take a look at the chart here. So in the last, couple of years, they're kind of, in my opinion, right, starting to really cap out on how many they're going to sell. Now, remember, this is a key, is that they cut prices. So that means most likely they're not going to make as much money, because you're selling cars, but you're just not making as much money per car. If you look at the sort of historical chart of Tesla, and this is something that I always try to make it very, very clear, and it's just basic math, but Tesla's always a hassle to talk about because there's so many Tesla pumper channels out there. And I get it. Tesla's done very well. The stock has done very well in the last couple of months. I totally get that. But in a long-term perspective, I want you guys to be realistic about these things. So if you bought the stocks, just for example, I can't remember what year they went IPO, so I don't even know if they were IPO at this point. But in 2012, they were making 2,600 cars. As you guys can see that. And then 2013, oh my God, they like 10x their production to 22,000. You guys see this? And then say, like, for example, from 2014, they went from 32,000 cars to 50,000. Oh my God, they're kind of doubling. And one of the things, and they doubled again, 2017 to 18, and then, like, for example, 20 to 21, they doubled again, right? They're doubling up the production. So their growth rates in the past was fantastic. Their growth rates in the past were fantastic, but when you get to be like, say, 2022, to go from, say, 1.3 million cars to, say, 2.6 million cars, it becomes much more difficult. And then to, say, go from 2.6 million cars to then double again to what would that be for, like, 5.2, it would be tough to double again, right? So this is something to where when a company matures, their growth rates slow, and it doesn't necessarily justify the stock price, doubling every single year. So when people tell you, and I want to be very realistic with you guys, when people say, oh, I bought Tesla in like 2015 and I'm such a genius because I, 1,000x my money, And then people say, oh, well, I want 1,000x my money too. But don't expect that to happen. You're buying Tesla at a later stage than the early ones. Do you guys understand this? I hope you do, because I understand that the pumpers, they try to convince you. This is what the pumpers do. They say, oh, no. Don't just be like Chris. He's an idiot. Chris is a total dummy, because Tesla is still in its early stage. Tesla is still in the 1980s of like what Apple is. And I'm just saying, I'm not seeing it. But other people will tell you that. I just don't see it. I don't think Tesla can have the growth rates that it did in the past, because it is now a mature company. And I know more car companies are entering into the game. It's a different landscape than it was back then. And again, their growth rates will slow. They also, I'm not a huge Tesla person, because they always have some sort of drama. They're doing a recall on their semis, some brake thing. Like I said, there's always some sort of drama over at Tesla. Then Elon is like ordered to delete some tweets by the courts, because it's something to do with like talking about taking away stock options for workers or something like that. And there's always some drama. And yes, I could do whole videos digging into Elon. Actually, honestly, I get Elon fatigued. I get tired of seeing his face. So I don't do it too much. It's fun every now and then, but I get tired of talking about it. So the Tesla Pumper channels, they have a really, affinity or addiction to his face. But I look at it all the time. If you do look at the software that I use, this would suggest that Tesla is 34% overvalued. Current P at 23. This would suggest fair P at 27, which I think is reasonable, to be fairly frank. And you could even go lower than that. You could say fair PE is like 20. When you look at like a Ford or a GM, their PEs are like 5 and 10, that kind of thing. So it's still trading at a premium compared to other companies. If you want to look at what Wall Street thinks, we're just talking about Tesla, just because this is a popular retail stock, and also shows you kind of like compare that to, say, the Buffett indicator or say the Schiller PE, and you all get kind of roughly the same numbers. So this would say like your best case scenario is, I don't even know who a CFRA is. I don't even know. We'll use Barclays. Barclays is saying, okay, maybe Tesla's 32% upside. Wedbush, Dan Ives, they're the Tesla pumpers over there. Dan Ives always says everything's going to go up. He says Tesla's a 8.45% upside, and then you're looking at some of the negatives. Citigroup and Bernstein will say it's 27% and 7% down. So take all these numbers and decide to do what you want with them. They give you Wall Street numbers, they give you different, so what the robots say, and also you look at the charts, right? So this kind of stuff is multiple things. If you're tracking a company, you're looking at what their earnings reports say. You're looking at what's going on in the news of these things, and sort of what your models say. So you can look at the charts as well. When you look at this thing, I think for me it's an obvious sort of level right there, right? So you're kind of, is it going to break above the 200-ish level or not? You're still down 45% last year, and this is kind of the level. To me, it seems obvious. So we're at a turning point, and also too, again, we've seen Tesla purchases slow. So this would suggest probably you're going to see a downturn, but who knows? Maybe they come out and they say we're making oodles of cash. I'm not seeing it, but because we know that kind of where deliveries are, and then we also know they cut prices. So the other thing is too, which is an interesting one, they're changing the tax laws. So I guess April 17th, not every EV out there is going to qualify for that EV tax credit. And I think it's like $7,500. So it's a sizable chunk of tax credit, but I think it was the Treasury that came out and they said they need to change the rules on that. The other thing too is as well, guys, I see articles like this all the time. There's going to be, what is this? The 8 coolest electric cars in the streets in 2023. The competition is real. So I put that out there because I want you to take it seriously. And a lot of people get burned because if you go on to the internet and you look at, YouTube comments, there'll be people always writing, oh, well, Tesla's undervalued. Tesla's really cheap at this price. And I'm just like, what are you talking about? Like, what are you smoking? So, and because when Tesla went on that crazy run, I was thinking, like, from the bottom of my mind, I wasn't saying undervalued. I was thinking, yeah, you could argue fair valued. Now I think it's tough to argue fair valued or undervalued now. But yeah, I get it. If the pumpers will tell you that buy Tesla any price is good. So I'm not seeing it, but that's just me. I would say though, if you were to buy the dip, and this is the risky stuff, is the stuff that's fallen the most, as you guys all know, we've followed the channel, would be the banks. But me personally, I have trust issues with banks because like I lived through the 08 crisis, and it's just like, oh my God, it's hard to trust what any of these people say. And like for example, Massachusetts, the state they're looking at First Republic is if they were doing insider stock trading or not. We looked at an article a couple days ago. It was the CEO he had given a bunch of money to his it was his brother-in-law and his son, and essentially it showed that this is just how this kind of world works. You hire your family and close friends, and and now it looks like they're doing insider sales kind of stuff. So we'll see. And it's funny, there's a really funny article where this one was the insider sales stuff that was at First Republic, but there's another company, I guess, called Republic First, another bank, and their stock has been getting hit really hard. And the headline is First Republic is not Republic First is not First Republic, but try telling traders that. So I guess the volume of this one has gone up, and people have been trading a different bank, unrelated, but they have the similar name. So I thought that was pretty funny. To be fair though, they're all in the same industry, so it's not like they're that disconnected. That they are, and they are connected. It's not like completely disconnected. And I keep seeing ones about Schwab. Schwab's been an interesting one because I think I personally think they're putting out a lot of PR to try to save themselves. There's been a lot of money coming out of Schwab. I personally think Schwab is one of the good guys. I have always heard everyone talk, positive things about Schwab. I've never really heard people say bad things about them compared to other banks. Like, I can go horror stories of all kinds of banks, but they've always been one of the kind of the positive ones. So it's been a bit alarming that people have been pulling money out of there. And again, like I said, I think it was the CEO bought a whole bunch of the stock, and they keep putting out positive PR on themselves. So this will be an interesting one to see what happens, because there was a recent one, I want to say it was like Morgan Stanley came out with a sell rating on them, and that was the first time in ever. I think that's what it was. That was the headline, first time ever sell rating. So it's hard to know what to make of these things. Also, I said to where if you're buying the dip on this stuff, the financials are where there's opportunity, but I think there's enormous risk in these things, and banks are more difficult to understand than other companies. We're really frank. Because you're dealing with a lot of different types of things you want to be looking at compared to where, like, for example, I'll just give you an example. It's funny because P ratios of banks isn't really quite the same as you look at other companies, because you want to look at their assets under management and sort of where their assets are, and also to inflows, outflows, right? Where's the money going? So on this particular one, they're underwater on one of their long dated bonds, but they may not be forced to sell them. I mean, they don't have to take the loss if people don't pull their money out, right? So this is sort of why it's all a trust game, and they're rather wanting PR. So I'm sure you guys do know the banks. You've been following this stuff as well. It's been a tricky one because, like I said, they should be a safe bank, but people have been pulling their money out. There's been an interesting development too, which goes back to sort of our whole theme of the market. Again, we're going into earnings season. This is a fun headline. That style again, how shopping got so boring. The basic gist of it, if you look at this chart here, this illustrates it really well. This is new general merchandise items available at retail stores as the sale of their, as the total of all the stuff on sale. So basically, how much new stuff is there? But the basic gist of it is that companies were not developing or aren't developing necessarily new stuff to sell people. So, for example, Apple, that they're not going to be so aggressive in new product lineup, because if you are worried about consumers and worried if they're going to come and buy stuff, if you're just not sure if people are going to buy stuff, you're not going to be spending a whole bunch of money on developing new products that they're not going to buy anyway. And remember, we're in a situation where companies need to cut costs, either fire employees or cut development costs, right? No R&D, no new stuff coming out. So this is kind of an interesting one, and it's something that it's been frustrating to me. Is I want to buy a new pair of Nike. I like Nikes. There are other brands out there. I'm a Nike person. I grew up in Oregon, and Nike's from Oregon, if you didn't know that. But yeah, there hasn't been really cool stuff that compels me to really get some, other than I need to get a new pair of shoes. And I am very picky on my shoes, so I wait till I find one that I really like, and then I buy 10 pair or whatever, and then I wait another couple of years and then buy 10 pair or whatever. But this is sort of how can I say how I think about these things, and it's kind of the same with Apple. So you're hearing these rumors, and they're saying, okay, is Apple coming with a headset? So this one's saying, I think this is Bloomberg, they're saying Apple's is 2 months away from debuting its first reality headset, whereas Wired was saying Apple's VR headset is likely delayed. So is it coming out or not? Who knows? That's been the rumors. And this goes all back to all of our market again. Is our companies cutting enough to make earnings attractive? And also too, for investors, can you say, hey, we're innovating, we're going to be selling new products to get more people through the door? That's the risk. And I'll be curious what you guys would be doing, right? So let's say you are CEO of Apple. I'm just posing this question to you. Would you go in attack mode? Would you be developing new products, like say the headset, and to sort of impress Wall Street and say, hey, we got this new product. We think customers are going to be excited for it. They're going to be spending a ton of money, and we're going to make a ton of money this coming year. Would you go with that model? Or do you go with like, you know what? I just worried about the future. I want to sort of batten down the hatches. I want to, maintain our business model that we have now. I want to sell sort of conservatively. We know this has performed well in the past. We're going to keep doing that, and we're going to consolidate. So 2 different strategies of running a business, and every company is going to come out with a different version of that. So we'll see what Apple says, and they are important to the market. Are they going to be aggressive or not in new product development? So anyway, that is the daily news. Hopefully this stuff is helpful for you. Always enjoy hanging with you guys, and I'll catch you next video.